else, get an opinion, because every situation is different. Sometimes people abandon property because the engine blew up in the truck. Sometimes, you know, they fully depreciated, like he said, and they're out of business now, and they're not doing anything with the truck. Sometimes you turn around and sell a truck for scrap. Sometimes you turn around and sell a piece of equipment to someone else who's in business because you're going out of business. Whatever the situation, it's always best to call someone or get you know, the tax expert in your office or in one of the other offices to help you through it. But the big thing is, do not delete the asset, because I was told at some point in time by somebody, and I can't tell you who told me, don't know, it was in one of my first couple years here, that, oh, if you've already fully depreciated, or it was a Section 179 from last year, you just take it off because it's already been depreciated, so you don't worry about it anymore. And you just delete it off there. I'm like, oh, okay, you know. And then all of a sudden we had a depreciation seminar and somebody said, oh, you're not supposed to do that. And I'm like, oh, really? Oh, well, I've been doing taxes wrong then, because I've been, you know, little circular saw, delete, you know, drill, delete. You know, it wasn't anything huge, but, you know, it was smaller items, and you don't delete them, you dispose of them. You have to dispose of them. So anyway, I learned my lesson kind of the hard way there. All right. So we'll talk about makers. It's modified accelerated cost recovery system. It's a depreciation system, and there's two depreciation systems under makers. There's general depreciation system, which accelerates the recovery of an asset's cost by taking greater deductions in the earlier years and use the shortest recovery period allowable. This is so that you can go ahead and get that tax benefit up front, a greater tax benefit. The alternative depreciation system is nothing more than straight line method. If you have a piece of equipment that will last you 10 years, cost $10,000, you take $1,000 per year. It's the slower of the two depreciation systems. So you have general depreciation, which is GDS, and alternative depreciation system, which is ADS. All right. So each type of equipment or property that you purchase has a property class. We have the 3-year, we have 5-year, 10-year, 15-year, but we'll go through some of them. It's also listed on your paper. It is page 15-13. It's one of the handouts that I handed you. So 3-year property includes tractor units for over-the-road use. This is one of the #1 issues we have with trucker returns, is people take mileage, or they do not depreciate the tractor unit unless that person's leasing, because if you lease, then you put into lease payments. But if the person owns the tractor unit, then you are supposed to depreciate it. It's a 3-year property. Qualified rent-to-own property. Racehorse that's over 2 years old when placed in service. Any other horse that's greater than 12 years old when placed in service. 5-year property includes autos, taxis, buses, and trucks. Computers, office machinery, which would include like copiers, fax machines, things like that. Breeding cattle and dairy cattle. That is something new, because I've just started doing a Schedule F, which is farm income. I did not know until a year or two ago that you are supposed to inventory cattle, goats, whatever the person has on their farm. That you're supposed to depreciate those animals. Didn't realize that an animal could be depreciated. So we all learned something new, you know. I've been here 11 years and finally learned something new there. But yeah, me and Miss Debbie went through that. And you have to name each cow. So, or describe each cow. It might be a description, you know, the black one with the white dot on his forehead, or the purple cow with the pink tail.
I'm waiting for you to start giggling.
Yasmin, are you giggling yet?
No.
So anyway, there she goes. But anyway, I did not realize you're supposed to either name the animals and have an inventory of them and depreciate each one of them, or, you know, have some sort of, like you said, you know, a bull or whatever, you know, they are. And yes, and a lot of the people who are in them for they're big business and they turn around and sell them at the stockyard and things. They do number them, so they possibly could have numbers. The guy that I actually do the farm income for, it's kind of he's just starting into it, so yeah. And we had a big huge casualty loss thing because some sickness came through and like killed a bunch of his goats and killed a bunch of his cows, and I'm like, Miss Debbie, what do I do? Yeah, that was the one we ended up having to go over to forms because he had like 5 different casualty losses. He had like 2 car accidents. He wrecked a camper, had the casualty loss on his farm, and something come through, some storm damage or something on his house. So if you have more than a couple of casualty losses, you have to go over to forms mode, and that's crazy. So, but anyway, that's where I learned that, you have to inventory cattle and goats and things like that. I didn't realize you had to do that. Do you have to do the same for chickens? She said she's never depreciated a chicken, so.
I think their life is a year.
Oh, their life is like a year or less, she said. Okay. All right. I mean, I just didn't know. I mean, here I'd done his tax return the year before, and I hadn't inventoried any of those goats or cows. And Miss Debbie's like, yeah, you're supposed to put them in and depreciate. I'm like, depreciate a cow? She said, yes. It has a useful life. I'm like, oh, okay, well, yeah, I guess it makes sense.
I worked for American Egg Products. They had chicken houses owned by Calhoun Foods, who were on the stock exchange, and because they traded, so they have to do a lot of stuff, and those flocks have to be depreciated each month.
Oh, really? Well, she was saying, I'm sorry, what's your name? Deborah. Deborah Thomas. Miss Deborah Thomas is here, and she said she worked for an egg place and that they had to depreciate flocks of chickens monthly. Oh, okay. Okay. So anyway, that's the lesson of the day is, depreciating animals. All right, so items used in residential rental real estate activity, such as appliance, carpets, furniture, those are all improvements to the real estate property and need to be depreciated over 5 years. Then we go to 7-year property, which is office furniture and fixtures, desks, filing cabinets, safes, things like that, agricultural machinery and equipment, and any property that does not have a class life and has not been designated by law as being in any other class. So any type of, forklift, bulldozer, things like that. 15-year property is certain improvements, fences, paving, shrubbery, etc. That's another thing that I've learned in the last few years, is that you depreciate fences. We had business over in Waycross who actually put down paving and a driveway and concrete, and they put down fence and shrubbery and stuff like that, and a well. Didn't realize you depreciate a well, so I've learned a lot working during the off season, that's for sure. All right, qualified leasehold improvements, qualified restaurant buildings and improvements, and qualified retail improvements are also 15-year property. All right, so we have residential rental property, the actual house, of course, not the land, but any building or structure such as a rental home, including mobile homes, for which 80% or more of its gross rental income is from dwelling units. You depreciate over 27.5 years. And then, of course, non-residential rental property, such as office buildings, stores, or warehouses, you depreciate over 39 years. And then we'll talk about convention. Convention just determines the number of months a taxpayer can claim the depreciation in the year that it's placed in service and the year it's disposed of. So we have half year, which means all property placed in service or disposed of at the midpoint of the year. In other words, if something's placed in service or disposed of on March 10th, you can depreciate it for 6 months. And you'll see on the sheet for the different property classes, it shows the allowable conventions. It's the third column over, and it tells you for each one which one is allowed. You have mid-quarter, which means total depreciable basis of property is placed in service during the last 3 months of the tax year, and it exceeds 40% of the total depreciable basis of all property placed in service during the tax year. So let's just say you bought a couple little small items for $500 to $1,000 at the end of the year, and towards the end of the year you bought a $10,000 bulldozer. Okay, because during the last 3 months of the tax year you purchased more than 40% of your total depreciable basis for the year in those last 3 months, you'd have to use mid-quarter. Mid-month is all property placed in service or disposed of during the month is treated as placed in service or disposed of at the midpoint of the month. So just like what it says, half year, mid-quarter, and mid-month. The mid-quarter is the only one that's a little bit different. All right, so depreciation methods. We have the straight line, which an equal amount of depreciation is taken each year during the asset's useful life. We talked about that. If you purchase something for $10,000 and it's a 10-year property, you do $1,000 per year for each year of those 10 years, unless you dispose of it before then. Declining balance, the cost recovery rate is accelerated, so you get a higher amount of depreciation in the first few years, and then it slacks off and you get less in the later years. All right, so business use percentage. Some assets are used both for business or investment purposes and also for personal. You're only allowed to claim depreciation for the time that it's used for business or investment use. You must keep documentation to determine how the use of the asset is allocated, and depreciation is limited by the percentage the asset is used in the taxpayer's business or investment activity. We've got an example here. So Andrew purchased a new laptop. It had a cost basis of $1,000. He cannot use the full $1,000 as his basis for depreciation because he only uses the asset 75% of the time for business. So 25% of the time he was checking his checking account, he was paying bills online, he was looking at his email, playing games, things like that. So because he used the asset 75% of the time for his business, then he's able to take 75% of the $1,000. Which is $750. It's limited to the business use only. Okay, so we have a question here. Makers consist of which of the following depreciation systems? Jessup?
Number 2.
Number 2, that is correct. All right, Brunswick, which of the following is not a maker's convention? The second one, full year, that's correct. Okay. Darlene paid $2,000 for equipment that she uses 50% for business. What's her basis in the equipment? $1,000, that's correct. All right. What are the recovery periods for the following assets? Jessup, you want to do the first one, tractor unit? Mm-hmm.
3 years.
Is it all the time or is it all the
I
time?
think it's one at a time.
3 years.
Okay. Computer, Brunswick? 5. A ditch digger, Jessup?
7.
7, that's correct. Brunswick, a residential duplex? 27 and a half. And Jessup, breeding cattle?
5 years.
Yes, I knew you'd know that one. Tina gets a laugh out of you giggling. It makes her giggle. She gets over here and starts giggling. Huh? No. The question was, are you from a farm, Yasmin? No, but Linda said she grew up on a farm. Oh, no. She was asking if you grew up on a farm. No, Jessup has a lot of farm returns. People up in the Odom and Bax area, I have family that they have a farm as well. So they grow tobacco and cattle and pigs, and so yeah, I'm related to people up in Baxley.
We had an ostrich one time too.
An ostrich farm? Okay. Yeah. Miss Debbie had an emu farm.
Yes, she did.
An alpaca.
It's like a smaller ostrich.
All right, so electing Section 179, you can elect to recover all or part of the cost of certain qualifying property up to a limit by deducting it in the year you place it in service, What type of property qualifies? It must be eligible property, must be acquired for business use, and must have been acquired by purchase. All right, so it must be tangible property. It must be, or other tangible property such as an integral part of manufacturing, production, or extraction of furnishing, transportation, communications, electric, gas, water, sewage disposal services, a research facility used in activities above, a facility used in connection with the activities for bulk storage, or single-purpose agricultural, livestock, or horticultural structures, storage facilities, except for buildings and structural components used in connection with distributing petroleum or any other primary product of petroleum. I didn't realize all this stuff was included. Off-the-shelf computer software and qualified real property. So most of the time we go under number 1, which is tangible personal property, or computer software, or qualified real property. Yeah, it's in the book. I'll find it for you in just a minute because I know it's in the regular book. All right, so we have a dollar limit. Property placed in service in 2013 cannot exceed Section 179 deduction of greater than $500,000. I know that reduces down for 2014 at the moment. Is that correct, Miss Debbie? Mm-hmm. I think it's supposed to be, I believe, reduced for 2014 unless Congress passes, the law at the last minute. So I would not, I wouldn't worry about it until January. I'd look and see what Congress has passed and then go from there. As of 2013, it was $500,000. If you acquire and place into service more than one item during the year, you can allocate Section 179 among the items in any way as long as the total deduction is not more than $500,000. Okay, we have to think about which is best for the client. Depreciation, we take the expense over a set number of years to spread out the cost and the tax benefits. So if they are looking to be in business, maybe they've been in business before and they're, in business again, or they've been in business a while and their income is increasing each year, you might want to depreciate the items rather than taking Section 179. This will allow them to have the tax benefits over a set number of years versus, taking the expense up front. Also, if you take all the expense up front to Section 179 and they're out of business next year, then you have to dispose of and recapture all the depreciation on those items that you put into Section 179 this year. So, in Profiler, never delete an asset property from Profiler. It can't just disappear. Okay, the IRS says, where did it go? If property has been abandoned, converted for personal use, sold, or disposed of, you have to do a disposition of property on Form 4797, Sale of Business Property. You may have to recapture depreciation depending on the situation. For example, suppose that Frank buys business equipment for $10,000 and uses it for 8 years. The total depreciation deduction he took was $6,000. Then wait a minute. Okay, then he sells the equipment for $6,000. The 6,000 threw me off. Okay. All right, so he paid $10,000. He took a depreciation of $6,000, so that meant he had $4,000 left to depreciate. He sells the equipment for $6,000. He must declare a recaptured gain of $2,000 because that's over the amount he has left to depreciate. The difference between the actual sales price and the depreciated tax base is of $4,000. Okay. So do we have any questions? If not, we're going to start on Profiler problem, the practice scenario number 11. I've got them. They're right here.
All the machines against the wall are the ones that work. Except for these behind Debbie. That one in the back corner. The machine in the front and the machine in the back corner.
Yes, and the answer key. Or I meant to. I did. I mean, whether they got it.
So we need to get Justin.
They should have it in their email.
Well, 2014. Yeah, they're out already. Are they out? I haven't looked.
Yasmin, did y'all get the problem and the answer key?
Yes, we have it.
Okay. I'm on cold medicine, so I'm kind of loopy this morning. So that's what she said. Did you send it? I said, well, I meant to. I was hoping I did.
Yes,
That's what I intended to do.
we got it.
I tell you, cold medicine makes you feel so weird.
Yeah. It makes me go to sleep.
Well, and I'm very sleepy, yes. Which is why this is not one of my better seminars.
You did an excellent job. You did
But-
a good job.
But I've been this way for a couple weeks. I've been on cold medicine for a couple weeks, so I think it's starting to kill my brain cells. I know. Miss
The
Linda,
doctor?
Miss Linda said she learned something new. She never thought about depreciating cows. Yeah, I can send it to you. This is actually current year. This is 2014, actually. You can go ahead into the 2014. I apologize. This practice scenario is one of the new ones from the 2014. Let me look, make sure that it is. Yep, 2014. So y'all can go into the new software and take a look at it and be blue instead of red.
I guess we're supposed to do this. Do it now.
Might as well. Might as well go and get it out the way.
Yeah, the rain.
It came earlier, didn't it?
It's going to be real impossible to drive and everything else.
I didn't look at the news this morning.
This is why we go in it. We just see